So this is something very important to know. If you have a margin account, you cannot do more than. Welcome to the Fit to Flourish podcast. It's your boy, Mr. Fit to Flourish, and today we're going to get into the different types of accounts on trading. Let's get into it. All right, so the two different types of accounts that brokerages allow you to trade on are going to be margin accounts and cash accounts. A lot of brokerages start you on margin accounts, and what those do is it allows you to borrow money from your broker to make bigger trades. A lot of times, if you're beginners and you're watching my page, you don't really work with margin. What you're working with is the amount of times that you're going to be able to trade. So for instance, in margin accounts, you can't do more than 3 day trades in a 5-day period of trading, market open. You can't do more than 3 day trades in a 5-day period. You need over $25,000. You need $25,000 or more in order to put on more than 3 day trades. And if you're watching these videos, you're trying to get into day trading, you really want to day trade, and you're going to be putting on same day trades. So this is something very important to know. If you have a margin account, you cannot do more than 3 day trades in a 5-day period. Number one rule right there for a margin account. Okay. The other thing about a margin account, okay, a margin account allows you to reuse any money that is gained that day. So for instance, if you have $100 and you use all of your $100 in your account, all the $100 in your account, you put on a trade and that trade goes to $1,000. Well, now you have $1,000 to be able to use in that same day on your account. Then you put on another trade, that 1,000 goes to 2,000. Well, now you can use all of the 2,000 and use that in the same day. So that is a benefit of having a margin account. Now, if we go to cash accounts, now a cash account is a little bit different in the sense that you can't use any extra money or borrow money from the broker to put on trades. So that's the number one difference. The other difference is going to be that you can put on as many trades in that 5-day period as you want. You can put on as many trades as you like. The only caveat is if you're doing day trades, you can only utilize the money that you started with in your account that day. So for instance, if you have $100 in your account and you put on a trade with all $100 and that $100 goes to $10,000 in one day, well, you're done trading for the day. You sell your position and you know that 100 went to 10,000, you sell your position, you're good, you close out. Well, you only had $100 to start with on the day. So that's all that you would be able to trade with. Now you have to wait for that money to settle next day in order for you to utilize the $10,000 that you just made. Okay, so that's a little bit different than a margin account, because on a margin account, you'd be able to trade with that $100. It goes to $10,000. Now you can use that $10,000 in the same day. However, you have to realize in a margin account, you would be having a second day trade basically. So this is primarily for smaller accounts. So like if you're less than $25,000, that's what's called an underfunded account. Okay, an underfunded account. So review: margin account, maximum 3 day trades in a 5-day period if you have less than $25,000 in your account. Cash accounts, you can put on as many trades as you like, but you can only use the amount of money on the day as is in your account. So on the day you have $100 in your account, you use all 100. Now you have to wait for whatever you made, you have to wait for it to settle next day in order for you to be able to put on more trades. Okay, cash accounts allow you to use the money in your account in order to invest. It's less risky and it's straightforward. Now in margin accounts, it allows you, like I said, to borrow money. And in order to put on margin or to borrow money from the broker, you need a minimum of $2,000 in your account. However, if you don't plan on borrowing money from your broker to put on trades, you don't need $2,000. Matter of fact, you could use $500 and take that to infinity. If you do decide to borrow money from your broker, there's leverage that the broker will allow you to use. So for instance, for every dollar that you have, some brokers allow you to use $2 in terms of the borrowing ratio. So like if you have $100, the broker will match that, give you $100. That's like a 2-to-1 leverage. However, if you have $100 and they give you $200 to borrow, then you have 3-to-1 leverage there. So trading with a margin account allows you to use leverage. So you borrow money from your broker and then you can use leverage to put on bigger trades. One thing about these margin accounts is that once you put on these trades, if you lose money when you're borrowing money and you start to run out of money, you get what's called a margin call. Okay, so the broker will actually call you up and say, hey, you need to put more money in your account or else you're going to owe us a big debt, because you're borrowing money and you're losing money. You're losing their money on top of your money. Like, no bueno. Okay, no bueno. So what I just explained with the margin account is called the pattern day trading rule. And that's basically where you have to have $25,000 in your account or more for unlimited same day trading privileges. A cash account allows you to day trade as much as you want, but allows less leverage. What does it mean to be a pattern day trader? It basically means that you're executing 3 day trades within a 5 business day period. So the fourth same day trade that you do will either be blocked or it can be executed and then risks your account being flagged. If your account gets flagged, then it kind of restricts how much you're able to trade. When I just started, this actually happened to me. And what you can do on that fourth same day trade, you can actually switch your account that same day into a cash account in order to prevent being flagged. So if you ever do run into this, keep that in mind. Now, this is not any financial advice, and I'm not a financial advisor. However, I would recommend that when you're starting off to use a cash account, because then you can put on as many day trades as you like and avoid that PDT rule. Also, it will restrict how much you're able to trade with, so you can't just keep recycling your money. Like if you turn 100 into 500, you can't just go ahead and start over trading, because once you start winning and you're a beginner, your head starts to inflate and then you start to kind of overtrade. So I like that about a cash account when you're just starting out. Anyways, if you have any questions, feel free to drop them in the comments. It's Mr. Fit to Flourish. Thanks for joining the Fit to Flourish podcast. I am outie. Good morning, welcome to the Fit to Flourish podcast. Let's talk wellness, finance, and growth.